If you've got a pension, you've won the retirement lottery, but a complicated one. Guaranteed income for life, that's what everyone wants, right? But here's the part nobody tells you. Having a pension can make retirement planning more complicated, not less. And the decisions you make around that pension, when and how to take it, can set you up for a successful retirement or leave you open to 4 hidden risks that most people and even advisors don't think about. According to the Bureau of Labor Statistics, only about 10 to 15% of private sector workers still have a pension, compared to nearly 40% only a few decades ago. That shift has created a real knowledge gap. And so most retirement advice you find today isn't built for people like you. Planning for Social Security, capital gains, Roth conversions, and other strategies you've heard about are heavily impacted by one simple fact. You have something that most people don't: a pension. So standard rules of thumb or generic tips likely won't apply to your situation, which makes it harder to find clear answers that you can trust. Most advisors aren't analyzing pension decisions every single week. And when you're making permanent choices like payout options, survivor benefits, or whether to take a lump sum, the wrong move can cost you tens or even hundreds of thousands over your lifetime. That's why working with someone experienced in pension planning is so important. Today, we're covering 4 hidden risks of retirement planning with a pension. Hi, I'm Rob, certified financial planner with RB Wealth Partners, here to help you get the most ROI out of life and your money. Risk number 1, inflation and fixed income. One of the most underrated risks in retirement is inflation. It's especially dangerous if you're relying on a fixed income like a pension that never increases. That's why one of the first things I ask all clients with pensions is simple. Does your pension include a cost of living adjustment or an inflation rider? Unfortunately, many people don't know. They assume that it does, or they never thought to check. But this single detail can make a huge difference. We've all felt recent inflation. Groceries, gas, utilities, dining out, everything costs more than it did before. In retirement, you've got to plan for that reality. That's why growing your money still matters even when you have a pension. If your pension doesn't increase with inflation, you need a plan to offset that shortfall. Otherwise, your income may not keep up, especially when major costs like medical care or nursing care show up later in life. Let me show you a real quick example of exactly what I mean. You can see here in this chart that for Frank and Joanna pensions, what they're expecting their living expenses to be when they begin retirement at age 60 are $106,000 a year. And what this chart is showing you, with living expenses increasing at just a 2.5% per year inflation rate, which is below the long-term average, closer to 3%, fast forward 20 years to when they are 80 years old, and now their same exact living expenses are $244,000 a year. In just 20 years, that's almost an increase of $140,000 per year for the same expenses. So you can see here in this brief illustration why it is so important that your money keeps up with inflation in order to have a successful retirement. So what can you do about it if you have a pension that doesn't automatically increase with inflation? One advantage of a pension is some downside protection. A portion of core expenses are covered for life. You know you're always going to have that guaranteed income, even if it's worth a little bit less down the road. That can allow you to be a bit more aggressive with your investments. meaning having a little bit more stocks than bonds, historically speaking, is one way to help keep up with inflation. Additionally, consider delaying your Social Security income. There's two amazing benefits about Social Security. One of those is that the longer that you wait, Social Security is guaranteed to grow at anywhere from 6 to 8% per year, depending on your age. I've got a separate video talking more about those details. You might start your pension now, but delay Social Security, which grows at about 6 to 8% per year, depending on your age. Locking in, say, $3,000 per month in Social Security that grows with inflation versus $1,900 a month that grows with inflation can add up to make a huge difference over the course of your lifetime. One of the most common questions we get: should I take the lump sum or keep the monthly income? Let's do a quick comparison. A lump sum gives control, flexibility, and the potential for investment growth, but it also means a lot more responsibility and no guaranteed lifetime income. The monthly income is simple, predictable, and guaranteed for life, but it locks you into one payment with less flexibility and limited legacy options. Which one makes sense for you depends on a few key factors. First, the growth rate of your pension. If you wait, similar to Social Security credits, the pension amount goes up. So how does that guaranteed growth compare to expected returns on your own investments? That's a big question. Some people think that they can easily outperform the growth rate of their pension, but that's not always the case. And don't let recent market performance be an indicator of what you're likely to experience in the future. Another factor to consider is your risk tolerance and investor behavior. If you take the lump sum, can you realistically manage the money on your own through market ups and downs and stay disciplined when things get a little rocky? Third, how dependent are you on the pension income? Is this pension going to be your main source of income for retirement, or is it just a small piece of a much bigger plan? A general rule of thumb is that the larger the pension income is relative to your total financial picture, the more important that it probably is that you take the monthly income. Whereas the smaller this total pension is relative to your total picture, the more likely that it could end up being appropriate for you to take the lump sum amount and invest it however you please. Just let it be known that even though you might have this idea in your head about which category you fall into, it's always going to be best to consult with an advisor to get a second opinion on these answers and let a professional share their ideas about which camp you fall into and which direction might be best. Thanks for joining us today. If you're enjoying this video, don't forget to hit that subscribe button for more just like it. There's no one-size-fits-all answer, but weighing these factors together point you toward the option that can best support your retirement and your goals. Another important decision that pension recipients are faced with is the choice between single life payouts versus joint life payouts. Single life means more income now, but it ends when you do. Joint life pays less each month, but it continues for your spouse if something happens to you unexpectedly. I always ask, if you are gone tomorrow, would your spouse be okay without that income? If not, the joint life income may be the safer choice. And sometimes that reduction is smaller than you expect, especially when you value in that long-term security, knowing that your spouse will have that same income for the rest of their lives. If you want higher income now and are considering the single life, a strategy called pension maximization may help. Here's how it works. You're going to take the higher single life income, and then you're going to use all or a part of the difference between the higher single life payout and the joint life payout to buy a life insurance policy. This way, if you pass away unexpectedly, your spouse still receives a tax-free benefit to help replace your lost pension income. Here's a quick example. If the single life option pays $3,500 per month, and the joint life option pays $3,000 a month, you've got a difference of $500 a month to work with that you would use to purchase a life insurance policy. Let's say the policy that you buy is $500,000. If you pass away early, your spouse is going to receive a $500,000 tax-free death benefit that they can use to create income, buy an annuity, or even preserve a legacy, something that you can't do by selecting the monthly pension income for life. This way, if you live a long, healthy life, you've maximized the income available from your pension and created a future liquidity event for your family. This strategy works best if you're healthy and insurable, and it must be properly modeled. It's important that you don't take advice about life insurance from your car insurance agent or a salesman you've never met before. Find a fiduciary who understands retirement income strategies and life insurance products to find one that best suits your needs. Finally, an overlooked risk: how your pension can impact your taxes. Here's what can happen if you're not careful. Your pension can make more of your Social Security income taxable each year. It can increase your Medicare premiums, those IRMA surcharges. It can limit your opportunities for Roth conversions and other related strategies. And if you're really not careful, having your pension can actually drive your capital gains into even higher tax rates. Many assume taxes drop in retirement, but with the pension income, Social Security, and portfolio withdrawals, taxes can actually rise quickly. If your pension has an inflation adjustment and much of your assets are in pre-tax retirement accounts, the timing of things like Social Security and Roth conversions is even more critical. That's why working with a team that can help you navigate these complexities is so important for maximizing your money and avoiding costly mistakes. So to wrap up for today, a pension is obviously a very powerful tool, but those hidden risks are real. If you're curious how we might be able to work together and help you create a plan for your pension, there's a link in the description below where you can schedule a time for your free consultation. Thanks for joining us today. If you enjoyed this video, don't forget to hit that subscribe button and stay tuned for next week's.